Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. On today's show, we pick up a topic that will be of great interest to you and me, to all savers in this country, especially risk-averse, conservative savers who put their money in fixed deposits. And joining me to talk about a potential big break and impetus for fixed deposit savers, term deposit holders is Tina Jain Kaushal, the personal finance editor at Business Today. And the subject that I have for you viewers is about the suggestion by the Indian Banks Association this to the Finance Ministry in the run-up to General Budget 2023-24, in which various reports and our own colleagues have confirmed that a suggestion has been made that all term deposits, fixed deposits of up to 5 lakh rupees be income tax free on the interest that is earned on those fixed deposits. And this is a demand that banks have made for it to be free up to 5 lakh to be tax free. And whether this will happen or not and what are the implications, I'll discuss that with Tina. But before I do that, I just want to bring up some numbers for you, if we can, of the total amount of term deposits that exist in the individual category. And within that data, we can see that roughly 64% and a little more than that, or around rupees 29.71 lakh crore. And here you have that chart, term deposits. This is Reserve Bank of India data. The bulk of the deposits are in the 1 lakh to 15 lakh category. These are individuals, not any other category. Under 1 lakh is 9%, as you can see on the screen. Then 1 lakh to 15 lakh is 64.37%. Greater than 15 lakh is another 22%, and deposits above 1 crore around 5%, just a shade under that. So this is the size of term deposits in India, and if you were to compare these numbers with the total assets under management of the mutual fund industry, it is still short of 40 lakh crore. So fixed deposits outnumber the mutual fund and total equity market investments in India. Tina, coming to you, how significant would this be? There are news reports, and our colleagues Anand Adhikari and Karishma Asudani have also spoken to sources, and they have confirmed that there are indeed some suggestions to this effect that have been made. We'll have to wait for what happens on budget, but how significant is this demand for savers and fixed deposit holders?
Hi Siddharth. Yes, this is a very significant demand, and I want to start with saying there is already some tax benefit given to FD tax holders, which is under Section 80C, which says that if you make a fixed deposit for the period of 5 years, then it is tax free. But the regular FD is not tax free. There, the interest income is taxable. So, if it happens, all your regular FDs will be made tax free. There will be no interest, no tax on the interest income. And we have seen over the years that that the share of bank deposits has actually gone down. So if I compare the number of 2020 with 22 financial year, it says that the bank deposits have actually come down from 35% to 22%, and the reason is the decline in the deposit rate. So from the customer perspective, definitely it is good. We don't have many avenues to invest in FDs, but from the bank perspective also it is very much required. Because of declining deposit rates, they are having this widening credit and deposit gap, where credit is going faster than the deposit rate. So definitely this is a much needed step, where inflation is going so high. We as consumer do not have many avenues, where we have the negative real return on FDs. So if it happens for consumers, it will be definitely a big step.
Let's also compare the tax treatment of fixed deposits with other forms of investment, including mutual funds as well as insurance. Although I am of the view that we should not treat insurance as a saving, insurance should be seen primarily from the very term that it connotes, which is to insure yourself against various kinds of a risk. In comparison to mutual funds, the biggest disadvantage beyond the 1 lakh cap that you spoke about is the tax treatment. And recently, I had interviewed Revenue Secretary Tarun Bajaj, who in a different context said that this budget is likely to explain and perhaps clarify and do away with the different variable capital gains tax treatment that we have across asset classes. We'll wait for that to happen. So, is this a case of the banks trying to say that they want parity with the mutual fund industry, or is it driven by some other desire?
Clearly, parity is required, but in mutual fund cases, there is a holding period of 3 years, and those funds are called equity-linked savings schemes, where the maturity amount is tax-free. And similarly, on insurance, there is a lock-in period of 5 years. If you don't serve that lock-in period of 5 years, your entire amount becomes taxable at maturity. So it's not that short-term investments are tax-free. You have to be in the game for long period to have tax free income. So if we take the case of ppf, it is 15-year investment. If we take the case of any other sukanya samriddhi scheme, it's a long term investment. So if banks are saying they want fds to be tax free, definitely government will have to give some lock-in period to make it at par with other avenues, like you said, mutual fund and insurance policies. But yes, there is a desire, because there is a widening credit deposit gap which the banking industry is facing. If I take the example, if I look at the number of November, credit has grown by 18%, while the deposit has grown just by 8%. So there is a gap of 9%. So banks are having this shortage of funds which they want to fill through deposit, because obviously they are cheaper than other modes of raising money. So yes, banks have the need to have more deposit at this point of time, and therefore this proposal has been made to the government. But clearly, to be at par with other avenues, there has to have some lock-in period. Otherwise,
But
life
Tina,
insurance. Yeah.
To take that point about lock-in forward, explain it to our viewers, to the layman. When we take a term deposit, it is for various durations. You could do it for 7 days and more. But a bulk of term deposits are actually in the 1 year to 3 year sort of time frame. I don't have that exact data in terms of the distribution, but this is what we can largely assume. Isn't that a lock-in by itself? Because if you were to prematurely close the deposit, you would lose out on the interest income, and there are some deductions also that you have to face.
Very fairly said, Siddharth. But if I compare with the period that mutual funds have for equity linked savings scheme, it is 3 years. And if I compare with insurance, it is 5 years. And we already have tax free FDs where the lock in period is 5 years. So people don't go in long term FDs because there the interest rates are very much lower compared to 1 year period. So for example, if I take the FD rate of SBI for the period of 1 year, it is around 6.1%. And if I compare the same rate for 5 years, it is around the same percentage. I'm getting only 6.1. And when the interest rates are so volatile, why should I invest my money for long term in FDs for 5 year term? And that is the reason tax-free FDs are not popular in India. And banks are demanding that from the day one, like from the year one, which is very popular as the number suggests, they should be made tax-free. But
But
again,
Tina, I want to interrupt you there. You said fixed deposits aren't so popular, if I heard you right. But explain the
the
numbers to
tax-free,
me.
tax-free, yeah.
Tax free fixed
Yeah.
deposits aren't so popular, because if you look at the overall term deposits, and again by RBI data, if you were to look at the category wise distribution in the individual category, the number for March 2022, and there must have been a change in these numbers, is 93.28 lakh crore. This is term deposits. and there are other categories. If you take a look at the overall banking system deposits, that goes up to almost 153 lakh crore. Again, there is a lag. This number is perhaps even higher. So, what are the chances that it would be done in this budget? The question I am really asking is, why now? If it's not happened all these years and there is this significant 10% difference between credit growth and deposit growth, why would it happen now according to you?
So I think it's difficult if it happens, but if it happens, there will be some measures around it so that life insurance and mutual fund products don't become unattractive. And we have seen in the budget so many proposals are made, but very few actually see the light of the day. But what one proposal I would like to see is to increase the limit of ATC from 1.5 to at least 3 lakh or 2 lakh. That is the real difference for consumers it will make. And also, Siddharth, I will want to bring this point that ATC is mostly compulsory investment. We don't get many benefits out of it because tuition fee and EPFO, they actually make deductions for us, and we don't get over and above those investments. So if that limit could be increased. But coming back to the point of FDs, it is not just one product which we can see as a standalone product. From the entire basket of products will be affected from this increase, and mutual fund and life insurance industry will also have similar demands. But if it comes, definitely it's a very welcome step for consumers. There is no doubt about it.
I am reminded of many years ago when after the UTI fiasco, and that was a time many savers would recall, perhaps not in the younger generation, about how there was a triple E philosophy, which meant exempt at the time of investment, exempt on the interest accrued, and exempt at the time of withdrawal. From triple E, many of us moved to the EET, which is exempt at the first two stages but taxed at the third stage. And then, of course, as mutual funds grew, like you said, there is this tax arbitrage, which is a very, very attractive reason for mutual fund investments. Yet, the overall numbers suggest that India is still a fixed deposit nation, despite the fact that in real terms returns are less. So, would I be right in saying that in your own experience of having tracked personal finance, what are the chances that the Modi government would do this in 2023, which is 1 year before the next general election, and the budget in 2024 will largely be just an interim budget. So, effectively 2023 could be the chance. What's your own gut feel on this?
So if I look at it politically, as you said, elections are due next year. Very much chances it should it will give a very advantage to the existing government, because whatever said and done, how much we are investing in equities, how much we are going for mutual funds, FD is the first love of all Indians. The number says it all. So if it happens, definitely the government will get an edge because it's a big step. But again, there is an ecosystem, because banking product cannot be surviving alone. There is an ecosystem where other products also looking for some advantage. So if at this point of time, it looks a bit difficult to me, but if it happens, it will be a welcome step.
You made an important point, Tina, where you spoke about the fact that a change of this sort, if at all, and this is just a wish list, no one knows what will happen in 2 months from now, it is going to have a ripple effect on the entire ecosystem. And savings, they are interlinked ultimately. Different types of instruments are chosen depending on individual needs, perceptions, risk ability, and of course, the amount of surplus income that you have. Also, tell our viewers about how do you see it globally, comparing globally, because much of the Western world, the advanced world, has for years till recently lived with 0% or even in some exceptional cases negative interest rates. So, all the money you couldn't park it in banks because you were getting nothing. So you ended up in the markets, you ended up in various other kinds of investment, and with the deluge of liquidity also ended up in crypto investments. India's case is different. Globally, how would we compare if a change of this sort were to be made, Tina?
So if I compare globally, if we take the case of the US, there also interest rates are very low. Over the last 1 year, we have seen that interest rates have actually grown and they have reached to the point of 2 to 3%. So if FD is made tax free from the year one, it will definitely it will definitely attract more money as an investment avenue, and the banks will have surplus liquidity with them definitely, which they are short of as of now given the credit growth rate they are facing. So for India it means, for banks in India definitely it means surplus liquidity. For banks, if I look at abroad, might be we can see more NRIs coming and investing over here, because there the tax advantage as well as higher returns they will get, because there the though the interest rate have risen 2 to 3%, still it is not as attractive as Indian FDs give to them.
Absolutely, and this is quite a significant topic because it affects massive amounts of people. The data, we haven't tried to go too much into data, but it's very clear. India, if you were to describe it in a few words in terms of saving habits, you could call India a fixed deposit nation. And amongst the largest economies, this is one trait that we perhaps share along with China as well, where there is also a significant preference for fixed deposits. It's the nature of economic evolution, and where we stand, that is also significant. Tina, one last point. When I spoke with the former revenue secretary who just demitted office a few days back, Tarun Bajaj, he was very clear and very detailed in the fact that it is time to consider, and he of course said that it was his personal view because budget details cannot be revealed, uh, about sorting out the arbitrage that drives some of investment decisions in terms of capital gains treatment. And we know when it comes to equity, less than 1 year, how it is treated, taxed at a higher rate, above 1 year at a higher rate. Do you see a sense that the government could bite a bullet on this aspect also in the forthcoming budget, again in terms of timing and its relevance and its results?
Definitely, Siddharth. This is one thing I am positive about, because capital gain is something which differs from product to product, investment to investment in India. As you said, for equities it is 1 year. For debt funds it is 3 years. If you sell it after 3 years, you pay less. Otherwise, it is more tax that you are paying. So definitely, holding period is differing from product to product, which is actually creating a chaos also. And the government has been talking about making income tax laws simpler. So if we have one holding period, definitely arbitrage opportunities will go away, and it will make income tax simpler for all of us. Why should we have different holding period for different assets? There should be one
How would
holding
it
period.
impact, how would a uniform period impact real estate as a investment class?
So, real estate as an investment class, I think, should be long term only, because we haven't seen buying and selling in real estate very frequently. So, right now, if I'm not wrong, it is 3 years. So, definitely, if you make it 1 year, then it will have a problem. So, for real estate, it has to be 3 years or more. And
Yeah, that's a valid point. I think we could differentiate between real estate and financial savings.
yeah,
Real
financial
estate,
and physical savings. Yeah, we
yeah,
can
I think we need
differentiate.
to depreciate. I mean, differentiate between this. For example, even gold, which is
Right.
pretty illiquid, despite whatever we may tend to believe, except in times of emergency where it may be used for collateral, and at that time there is no guarantee whether you will get what you had actually believed you would get in terms of the daily changes. So real estate, gold, different classes of investment, that's what any reasonable investor should look at. And financial products in their very nature are different, with far more regulated entities operating, and different fee structures as well that get involved. Tina, we'll wait to see if the government bites the bullet, not just on capital gains clarification and uniformity, as you put it, but on this very significant issue of fixed deposit tax treatment. I'll just end by saying, viewers, that if you were to ask me my own view, the biggest calculation that the government will do if it were to consider the IBA demand is the revenue loss. And given that government finances are still stabilizing after the recent upheavals, to me it's very clear, despite the logic and despite the inherent positive populism that this kind of a step would introduce, the final call will be taken on the bottom line impact on the government's own finances in terms of the revenue foregone with such a move. Because remember, a bulk of over 64% of all term deposits in the individual category are between 1 lakh to 15 lakh. We don't have further granular data on that, but it's clear that that will be the parameter on which this decision and this argument would be won or lost in the Ministry of Finance. We'll have to wait for that till the 1st of February. But for now, it's a wrap on this episode of Easy Economics. Tina, thank you very much for your time with us today. We'll be back with more. Stay tuned in.